Just a Livermore could be right in a way most traders only dream about. He saw huge market moves before other people accepted what was happening, and he is still remembered for being short around the 1929 crash. But the part traders usually need more is the uncomfortable part. He made fortunes, lost fortunes, came back, and then lost it again. The lesson is not just that a trader can be very good, but that being very good does not protect you from what the last result does to the next decision. You see a smaller version of that after a clean winning trade. You read the move well, you enter from a decent place, and price does what you thought it would do. For a while, the chart feels easier than usual. The last decision worked. And because it worked, the next one starts to feel a little bit more obvious before you have actually even checked it. That is usually where the change begins, because the next setup starts forming, but you are not looking at it from the same place anymore. The feeling of the last win is still sitting in the background, and it makes the trade look a little bit cleaner than it is. You accept a small weakness in the entry because direction feels clear. You give the idea more trust because the last idea was right. Nothing about it feels wild in the moment. It just kind of feels that you have confidence. But then the next trade is open, and the price does what it often does. It stalls. It pulls back a little, doesn't immediately reward the entry, and if you had taken the trade cold, you might judge that more simply, but now there's another layer. Closing the trade means more than taking a normal loss. At that moment, it means admitting that the confidence from the last win may have followed you into this one. So you wait. You give it another candle. You look again at the level. You remind yourself that the larger idea can still be valid, and some of that may even be true. Which is why this kind of mistakes is really hard to catch. The trade can still have a reason behind it, but the way you are holding it has changed. And if it does move in your favor, the pressure does not always disappear. Sometimes you close it too quickly because you want to protect the feeling that you are still reading the chart and market well. You do not want the second trade to take away what the first trade gave you, so the win gets managed for relief, not for the original plan. Now, after enough of those trades, the results become confusing. The strategy looks inconsistent, but the rules were not the only thing that changed. Some entries were taken because price was in the right place, while others were taken because confidence was still high. Some exits were clean, while others were delayed because the loss felt like it said something about you. The journal starts showing trades, but underneath those trades, there is a pattern in how each result affected the next one. That is the part of Livermore's story that stays useful. A trader can see something real in the market and still lose structure afterward. A good read can turn into overtrust, while a strong win can make the next setup feel safer than it really is. And once that starts happening, the problem is no longer only the trade in front of you. Instead, it is the residue from the trade before it. If you want to catch that earlier, xChief can help you keep the record more honest. When you can look back at the plan, the entry, the size, and what had just happened before the trade, it becomes easier to see whether you were following the setup or still carrying the last result into the next one.